Inflation is retreating. The effect of rate hikes take time to be felt by the consumer and the economy, and yet they've not been entirely felt yet. We're all aware of the fixed rate cliff coming in Australia, where there's a meaningful portion of mortgages that were taken out at very low fixed rates that will now have to be converted to new, much higher rates. This is just one example of how there are delays in the timing of when interest rate rises are felt, and delays like these are also felt in other economies, though through different mechanisms, economies like the US. It takes time for the effect of interest rate hikes to take hold. They increase the cost of doing business, reduce demand, and ultimately hurt the earnings potential of companies that people are invested in via their share portfolios. Our proprietary leading economic indicator model is pointing to a high chance of recession globally. However, that doesn't appear to be in equity prices. Just looking at US equity valuations, we can see that the market isn't even trading at fair value, so it's pricing in not only no recession, but better than average conditions. Given the cost of doing business is up due to higher borrowing costs, higher labour costs, and we're likely to start seeing reduced demand, we don't believe the next few years will be better than average conditions. It's our view that if the price you pay for an asset isn't providing enough return potential or compensation for the risk being taken, then look to diversify elsewhere. The good news is that not all markets are priced for a Goldilocks scenario. Emerging market equities and their bonds, value equities, traditional boring old government bonds, all of these are offering reasonable prices, so offer an opportunity to diversify your portfolio away from the areas that aren't compensating for risk and towards those that are. However, it does require investors to do something different than the majority of the market, but you can't get a different result doing the same thing as everyone else. It can just be uncomfortable for periods of time if you aren't moving with the herd. Australian investors are obviously heavily invested in Aussie equities, but also the market majority is heavily invested in US equities, particularly the large cap tech sector. These are areas we think carry higher risks, yet are priced as if there is little risk to growth and profitability. We instead prefer to focus on those opportunities that we believe offer an asymmetric payoff profile, more upside, limited downside, and less risk to the downside. So our investments are naturally concentrated in these areas. Whether it's emerging market equities, government bonds, UK equities, or the global value style of investing, these also present a meaningful positive future return potential without having to pay a large premium for it, and hence this is how we have positioned our portfolios. We have less US equity market beta, far less exposure to mega cap tech, more granular exposure to sectors and regions that are priced more appropriately, increased allocations to bonds, and no exposure to sub-investment grade or junk bonds.